Okay, greetings. So this is the last part for statement of cash flow. Okay, so before we learn cash flows from operating activities, then we learn cash flows from investing activities, and the third one we learn cash flows from financing activities. So first thing first. So what is under financing activities? Finance means source of funds. So source of funds can get from share capital when we issue shares. So positive sign. When we issue shares, we involve share issue cost. That will be negative sign. Alright. So got S, share issue cost. And then in return, we give dividend. So sometimes we have to look at the dividend payable account. And sometimes share capital can reduce. That is when the company buy back the shares, or we call it shares redemption. Okay. Besides getting monies from the source of funds from the shareholders, we also get monies from bank loan, from the bank. So when we get bank loan, cash flows increase, but in order to service our loan, we have to pay interest on bank loan. Alright. So that's under cash flow from financing activities. Okay, you know that in ASB it can be O or F. Alright, so in textbook it's only for O. In WAIS exam, you always have to check the additional information. Repayment of bank loan is considered financing activities. We pay back our loan, so negative sign. Debentures is another form of loan that we get from the public, or get from the get from the public, or get from the companies. Alright, again, debentures, a form of loan that we get from the companies or from the public. So financing activities increase when we get debentures. When we repay back, repay means pay back our debentures. So what happens is we have negative sign. So we have to service our debentures by interest on debentures. Again, it's negative sign. So these two will be negative sign for financing activities. Alright, so again, let me remind you, ASB allow dividend pay and interest pay as operating or financing. In the textbook, they only acknowledge dividend pay as financing activities. WAIS exam, always look up for additional information. In regards, if it's a banking institution, then make sure these two would be operating activities. Alright, so let's look at the first thing. Cash flows from financing activities can be from the shares. So when we issue shares, there's an increase in share capital. So share capital increase, there's an inflow. When share capital decrease, it can be a buyback, redemption of shares. Okay, remember, if it's a bonus share issue, it comes from either retained earnings, equity, or general reserve, or asset revaluation reserve from the equity part. So it's a non-cash item. So remember, not just because of share capital increase, it can be positive cash flow or negative cash flow. Sometimes it's just no cash flow because it's bonus share issue. When we look at bank loan, we look at NCL portion. So NCL portion increase, there's more loan coming in. Decrease means repayment. Debentures, the same thing. When there's an increase of debentures, there's more inflow. When the decrease of debentures means repayment. Alright, so I hope you still remember how to open up your share capital account, equity part. So share capital increase on the credit and reduce on the debit. So opening balance from SOFP, closing balance from SOFP. When there's an increase of shares issuance, we call it applications. When there's bonus share, it can be GR, ARR, or RE. What share issue cost will be here. So if we're able to find a missing figure here or missing figure here, when it's a reduce, it's a redemption. When it's an increase, it's a share issuance, we write applications. Alright? Okay. When it comes to payment for dividends, we always look for how to open retained earnings account. Retained earnings account, you learn opening balance here, increase by profit after tax. When there's a general reserve transfer to retained earnings, will be on the credit. Then we look at if there's a loss, will be reduced retained earnings, general reserve transfer from retained earnings to general reserve, then it will be minus sign. When there's share issuance using retained earnings, which is bonus share issue, then it will reduce retained earnings. Dividend payable will be here. If there's an account called dividend payable, make sure we debit dividend payable and when there's a dividend payable account, make sure we credit dividend payable and we debit retained earnings. And then the portion here will be the dividend paid. Always remember, not all the dividends are paid when they're close to retained earnings account. We have to find the portion that is not paid. Okay, we have to find the portion that is paid. Again, not all the dividends in retained earnings is actually paid. We have to find the portion that is paid. Alright. So I guess that's about it for today. And then the last thing that you will see, it will be look like something like this. The last one will be, we look at net cash from financing activities. So when there's additional share capital positive, share issue cost negative, dividend paid negative, then we have net cash from financing activities. The last thing will be net increase in cash held. So what do we do here? How do we get this number will be, we start from net cash from operating activities, add net cash from investing activities, add net cash from financing activities. And this number can be positive or negative depending on how we end up with. And then the last one will be calculating our cash and cash equivalent at start of the period and cash and cash equivalent at the end of the period. When we see the opening of cash and cash equivalents and the closing, this number changes would be able to be explained by the net increase. So 51535 plus 380 will be 51915. So this is how statement of cash flow reconcile between statement of financial position with statement of comprehensive income. So this is how SOCF can give more additional information to investors to make decisions. Alright, so when we want to count cash and cash equivalents, remember it's cash at bank, cash in hand, petty cash, and investment like term deposit less than 3 months. However, if the cash at bank is in a negative amount, in this case, normally in SOFP, it will be under current liability. For SOCF, cash flow, it will be counted here and it will reduce cash and cash equivalent. Alright, so that's all for now. Hope to see you in class so we can discuss the interpretation of those numbers.